All right, XMAX trading here. Just want to look at some CARV thesis, the bull thesis part 2, which was published to Reddit less than a day ago. And go ahead and subscribe to the channel if you haven't already, and hit the like button, helps the algorithm, and hit the bell icon for notifications for the channel. So the CARV bull thesis part 2, March of the Penguins, and this is not financial advice. Damn it, Jim, I'm a doctor, not a financial advisor. So, do your own research, seek transparency, the link to my resources. This is on Reddit. So I hope everyone gets the rest of the weekend, because this week is going to be active. After last week's explosive surge upwards, we're entering a new phase. Sophisticated actors, corporate interests, and new factors are in play for CARV. But the elemental principles remain unchanged. With some new additions, I'm dropping this at a 0 dark to give us all time to digest and discuss each component before Monday launches. So the micro float scale, short interest volume, delta valuation, fundamental plus the current price, popular volume surge, social demand, the unmeasurable, and what is the unmeasurable about this stock. Scarcity principle equals share price. So all these different things in this DD equal the share price. So the micro float scale, the conquerable iceberg. At the time of the writing, one can find float estimates from 450,000 to 900,000, so under a million, depending on the float calculation methodology, which is why there's such a wide range of short interest percentages, and more on that below. Regardless of the context of the whole market, it is the one of the smallest there is between the 18th and 33 smallest floats. It's listed in the micro float because it's so rare. So there's the free float and there's the total stock. So the free float's what's tradable. The rational goal of retail investor is to conquer the float and to control the bid-ask squeeze in squeezes like GME and AMC, and their float size made it impossible to outcompete large institutional capital. But with microfloats, the definition of a whale is more easily democratized. This is pretty damn interesting. I never thought it that way. It is easier for the average Joe to own 10% of 100,000 shares or 10% of 10,000 than 100,000. In CARV, your 1,000 locked down shares in a float of 900,000 carries far more weight than they do in AMC's present float of 448 million. True. Market-wide, there is a finite number of retail investors with capital and risk tolerance to lock down shares and wait for control. It takes far fewer of those in entrenched to conquer a small float like CARV. This is how the smaller float is protected for retail traders. As described previously when we talked about how the market laughed off Hedgehog's recent sale. As the population of entrenched retail longs, people like me with large holdings, a low average price, and high risk tolerance grows, we leave fewer trading shares from manipulative efforts to scare shareholders and with rapid price swings. Thus, in a larger float, entrenched retail might be able to protect only 30% of outstanding, to leave 70% for the whale scale capital to toy with, investor psychology. But in CARV, it takes a lot fewer of us to protect a much larger stake of the outstanding, leaving very little maneuver room for those with malintent. That's a pretty interesting thought. Of course, there exists a well-known risk to the float size, which commonly occurs in squeeze and offering. The company attempted to raise capital by issuing additional shares in the setting of an elevated share price. We saw this both in AMC and GME. It's fair to assume we would see it here. Normally, 81% insider holdings is a bullish of confidence, but could they attempt to cash out on the rally? Let's ignore for a moment CARV's decades-long history of shareholder support in the form of repurchases, and instead hypothesize a theoretical worst-case scenario, simultaneous total liquidation of all insider holdings, which is not actually possible as much as outstanding is tied up in compensation package and the restricted shares, and institutional positions, and an offering of the maximum authorized shares up to 10 million. This equates to a maximum increase of 188%, which would make it the 537th smallest outstanding in the market. Still a minuscule iceberg in the lowest percentiles of size. For context, GME squeezed with 70 million outstanding, and AMC with 85 to 450 million outstanding. In addition to only slightly increasing the iceberg size, this offering would also strengthen the balance sheet, raising if it happened at current share price of $172 million in cash. This kind of strengthening would cause GME to actually continue to rally. Therefore, a squeeze surviving offering means the demand must outstrip supply, and for the reasons below, this seems likely. The delta valuation, by comparison, 57 to 200 is based on the fundamentals alone. So CARV could be $57 to $232, not financial advice, do your own research, not recommendation. This DD thinks that price target is based on fundamentals alone. 57 to 232. Now the market has clearly concurred the company is worth more than the cash in its pockets. Their $75 million cash position, worth equates to $20 a share, is worth examining mathematical steps of corporate value. Our initial poll, since removed on advice that could be used against retail investors, found $9 to be popular valuation. It seems that this is a conservative approximation. Below, we'll focus completely on raw values such as revenue, setting aside moment for a moment, the extrinsic factors such as microfloat, short squeeze potential. Probably the clearest comparator for CARV is publicly traded MDI sector BYFC, which is similarly found in the mid-40s. Calls the largest black-led MDI. CARV's most recent balance sheet is 10K filed June 29th, documenting the status on March 31st, showing significant strength. This is the major catalyst for its rise. It documents assets worth $676 million in assets, shareholder equity of $50 million, debt $53 million, cash and equivalents $75 million. Price of sale comes out to be 1.64, price to book 1.38. And then BFYC's numbers are there. CARV currently trades at a market cap of $91 million, BFC at $233 million, and BYFC is at 2.54% of CARV's present valuation, despite BYFC's weak performance. CARV is actually more valuable compared to BFYC's numbers. Thus, in the rubric, CARV falls between 0.85 and 3.46 times as valuable as BYFC, which translates a market cap of $191 million. Share price. Now, you clearly look at the bank valuation of an enormous complex topic requiring subspecialty education. This is a highly reductive view. One could cherry pick less appealing statistics like the quarterly EPS of CARV versus BYFC, look at CARV's less favorable EPS, or more appealing ones like annual revenue. CARV has more annual revenue than BFYC. To make different arguments, the idea is that these institutions are in the same ballpark, and CARV appears to have better seats despite trading at far less. The concept of valuation target of $90 is a conservative approximation about the general idea, but assumes not a single cent of value from other appealing features of the trade. The microfloat. The point is that there's a change between CARV's current valuation and this range is not only substantial, but is based purely on the math alone, ignoring trendier concepts like surging demand of trendier concepts. So the short interest percentage battle continues. As of this weekend, both the shorts and longs are heavily entrenched. Thus, as the part of the equation remains active. Finviz shows no zero shares available. Take the grain of salt, because IBD has led to update. S3 cites about 346,000 shares shorted, 9% fee. So yeah, S3 cites something different. Ortex cites something different. Ortex cites a 50% short interest. It's still pretty high. For new investors, FINRA publishes short numbers bi-monthly, which are roughly a week out from this date. With these numbers, you bring up your list, you see on places like MarkWatch and Finviz. The last update was triggered on CARV. Yeah, about 200 something. Upcoming FINRA data comes out Monday evening, which will reflect the settlement date June 30th. According to here on our CARV stock, about the short interest with corresponding settlement date of 6:30. Ortex showed, Ortex S3 showed different numbers. So the short volumes increased somewhat likely. It remains unclear what the effect of the hedgehog liquidation will have on the float calculation methodology, but appears to have increased the float to roughly 900,000. Thus, the short interest percentage of the shares floated in free float Both the numerator and denominator have increased. It's unclear which direction this will go. It's possible that short percent action on other tickers will displace it from number 1. But regardless, it remains extraordinarily high, an attractive proposition for new investors that adds upward potential. And most important, the short ownership percentage is just icing on the cake. Popular volume. Let's see, page 37 of the 10K counted 546 shareholders as of March 31st. The iceberg has clearly gotten more crowded. The exponential trajectory of popularity-related volume is obvious, but also absurd. Also absurd to write. An average volume of 400,000 peaking at 95 million. That represents a 23,000% increase in trading. All right, a lot more details here. Unique driver of the inflows appears to be the ESG impact-minded investors who support the mission of CFID, MIDs, CARV. I don't know what that is. Yeah, some stuff I'm not familiar with. Keeps the majority of the investment community federally supported mechanism to allow capital to penetrate and unlock conventionally underserved communities, creating opportunities for business homeowners and buyers, and to stimulate social upheaval and strengthen the middle class. The unmeasurable KBC retail investors have access to the market. In unprecedented ways, they're able to communicate about it openly and now account for 10% of all trades, probably more for stocks like recent catalysts. Born in place CARV. This is a perfect. So, to sum it up, this is a perfect storm of extraordinary events. The often cited $9 as conservatives. Approximate mathematician displays price tag ranging from between $57 and $232, which assumes no valuation beyond the book assets. Short interest percent remains entrenched, feeling explosive growth is extremely attractive. Short squeeze candidate with a rare alignment of other forces even more compelling. The risk story is a micro float, which is small enough to retail to conquer and will tolerate even theoretically maximize offerings. Popular volume demand is up in the thousands of percents with tailwinds. Most intriguing is unprecedented nature of this black swan may activate the Keynesian beauty contest and convert retail holders in change of their own price target destiny. Wow, this is pretty amazing. So keep an eye on this one, guys, and a lot here, a lot that I'm not familiar with just yet. So I'm definitely looking at this one. All right, guys, till next time.